Welcome to your results for the Underwriting DNA session that we held earlier today. I'm going to go through and share with you your results for your groups, but compared to the other teams as well, so you can get an idea of the different decisions, different risk appetites that you've all taken, and how that's impacted your financial results at the end of it. It's quite an interesting set of results we've got today because all three teams have had a very different approach to these. So what I'm going to do is go through and just firstly show you the class as a business. You can see essentially what you've been looking at in terms of the lines that you want to grow and the ones that you've wanted to leave, and then we'll have a look at the summary results. So first of all, we're looking at property. So team 1 is in blue, team 2 is red, and team 3 is yellow. So if we take each line, we can see that the first line, so policyholders, offices, banks and retail, has split the room. Team 1 have decided to quickly back out of this one. I think they made some decisions, particularly around the premium, to essentially leave this line of business, and we can see the results on that in terms of how much has come through. And for team 3, this is the one they're certainly most comfortable with within each line. And team 2 have also grown this one as well. Now, if we look at the results amongst all three, what's quite interesting is we can see team 1 and team 2 had quite a consistent approach across 3 different lines. Sorry, team 1 and team 2 have had quite a consistent approach. Team 3 have had quite a different scale going in between each one. So as we look in the middle there at manufacturing and processing, been fairly consistent. But then when we look at chemical, we can see that they're pulling out in that one. They've reduced their risk appetite in that section as well as team 1. So big difference going on there. Team 1 and team 3 moving out of the chemical piece, and team 2 going into that one quite large. So bearing in mind that's quite a risky line of business, we might see an impact going through on the results as we get to them. Next, we'll look at cyber. So firstly, manufacturing, and team 3 have gone in here big. And interestingly, like they did with the others, team 3 have gone in big for this one, but less so for the other two, so different approaches to each line. And team 2 have gone in, again, for all of them, quite strongly, and team 1, certainly the most cautious of the teams, reducing their premium in here as well, their gross written premium, through their decisions. So what does this actually mean? Because it's not necessarily just about your gross written premium, really about the profit that comes through from that as well. So let's have a look at some of these results. So, gross written premium as a whole, team 1, no surprise there. When we see them all pulled together, it's gone down, and I think that's a deliberate decision. Team 1, I think you'd say that you've done depending on what you've been reading and how you want to withdraw from certain areas. Whereas team 2 and team 3 have kind of consistently increased those, although we know through the breakdown that they've increased them in different lines. Combined ratio. Big curve on this one. That curve really represents the year where the cats came in big. So year 1 has been a reasonably good year for team 1 and team 3. Team 2 though have come in above 100% on all 3 years. So we do expect, generally speaking, teams to come in above 100% on years where there's big cats. And team 2, year 2 that certainly happened. Year 3 had a small cat. So not surprising that we see this curve going in. What we're really aiming for is that 100% figure to not be hit on the non-cat years. Then we got capacity utilisation, which is here really around your solvency. So how much are you staying within the requirements? And we are certainly looking at not going above 1. But really, we're looking at utilising enough of that capacity that your shareholders are happy their investment is being used. But equally, that we are not going to get in trouble with the regulators by going above what we are allowed to do. So team 2 have really gone through here in year 3. So there's going to be some losses that align quite closely to that those decisions. I believe it's probably going to come from that chemical section if you have a look in your results and see where those losses have hit within there. But team 1 and team 3 have stayed behind 1, so that's great. Team 1, just to note, lots of it's not being used, which as long as we're making a profit, your shareholders may well be happy. Just it is making sure that we're just conscious of how we're using that and there as well. So let's put your results in a bit of a league, a bit of a chart. So gross written premiums, we can see here the intention was to grow these, but just making sure we're growing them where we want to. So of course that's the challenge. So team 1 have reduced them. I'd say that was probably a deliberate decision and has worked out for them in terms of profitability. Team 2 have absolutely increased them. That comes with the risk. Team 3 have managed to increase those and still be reasonable with their profitability. Capacity utilization, so we can see the results there just broken down from the chart that I just mentioned before. So we're looking at making sure we're coming in below 1 on those. So pre-tax return on capital employed, this one I haven't mentioned yet. The reason I haven't mentioned this is because we're looking at this as a target for year 6. So we want to be hitting about 15% by year 6, but we will see some of the investments, particularly those of you, for example, that invested in the IT, you're going to have early costs that start to actually come through later on. So we're not too worried about that at this stage, but this is something that's going to be a lot more important when we look at the next section. This is essentially how much profit are people getting for the money that they're giving you. So we certainly want to be getting a profit. So team 1, fantastic there. We know that in insurance, there's going to be years that we don't, particularly years with cats. That's expected. So team 1's results here are looking really good, actually, for this one. And team 3 results also looking good. Of course, though, where those cats have hit in year 2, that's clearly had a much bigger impact there. Team 2 are going to have some challenging conversations, I think, when they're sitting down with their board and their shareholders around this one. So big risk appetite there for team 2, making sure whether or not that's paid off. One of the key things that's going to impact this is how much reinsurance you've purchased. So for team 2, if you've made big decisions about growing in certain classes of business, particularly within cyber, where we don't yet have much history to predict those, and we know that they're cat exposed, then if we're increasing what we are taking on and having a bigger risk appetite, we're going to want to have more reinsurance to make sure we're protecting those. Of course, reinsurance comes at a cost. Often you hit that button as you're completing the results, see the cost and back away from it. But the cost is there for a reason. It's because it's likely to happen. So it's really worth making sure that that's planned in if you have got the higher risk appetite. So then we've got combined ratio in there as well, finally. So we're looking to say, of course, combined ratios to be under 100, ideally under 90 in non-cat years, but we have got cats coming through. This is a training course, there's going to be lots of cats there for you. So just looking at the difference there. So bear in mind, you've all had the same results as this is rolled forward. It's your decisions that's going to impact how these are showing on the charts. So this is your results for year 3. Within this email as well, you've got your spreadsheet going. Have a look through, have a look at the decisions that you made and where those losses are showing. All of your loss information has updated in the reports along with us rolling this forward. And then next week, when we look at this, we will be looking at seeing what we can take from these 3 years to change our decision making and improve it, or remain it with it if that's what you want to do for next time. So to consider where we are against these targets. We have so far team 1 and hitting 2 of the targets here, so combined ratio below 90 in the non-cat years and remaining within capacity. The return on capital employed is actually what team 1 is doing really well in at the moment, but that doesn't come into play until year 6. Team 2 certainly growing the market share, not negatively impacting the other targets at the moment, and team 3 hitting all of those targets. So just the return on capital employed is the big difference between team 1 and team 3 at the moment with these ones. So different strategies for each of your teams, which makes this really interesting. So we look forward to seeing how these results impact your decisions next week.